Thank you, everyone, for attending today. Today, we're going to be covering 1031 exchanges and how these can help you guys maximize your gains, save on taxes, and move into that next property. So real quick, I'll do a little bit background on myself. My name is Ryan Prazen. I am the Director of Real Estate and Investments here at Good Life Property Management. I have been in real estate full-time for nearly 20 years. I got my real estate license back in 2006, my broker's license in 2007, and started in the business almost the worst time right before the great financial recession, but survived and thrived throughout there. Fast forward here 19 years, and here I am still working mainly in the investment space for real estate. And I'm really excited. Today we have Jake Schiro. He is the president of APX 1031 Exchange. They are a San Diego award-winning 1031 exchange specialist. They do this nationwide, but their offices are here locally in San Diego, which is great. They were voted Best 1031 Exchange Service in 2025 by the Real Estate Business Review. So congratulations for that. Here, Jake, I'll hand it over to you for a quick intro, but would love to hear, why you started APX 1031 Exchange and what you guys are up to today.
Sure. Thank you, Ryan. Happy to be here. Thank you for having me. As mentioned, my name is Jake Schiro. I've been doing 1031 exchanges for the last 6 years. Prior to that, I actually had experience on the multifamily brokerage side. So I've handled 1031 exchanges both on the transactional side as well as actually facilitating them as an accommodator. And I saw an opportunity in the marketplace. When I was doing the exchanges in the past, sometimes it would be difficult to get in touch with the accommodator. And a lot of that is very time sensitive. We're going to get into the timelines and all of that with the exchange, but I just saw an opportunity to really be a partner with clients as they were going through this process. And hence that was where APX kind of was born. But I do feel that it is helpful to have that background in the transactional side and how to manage the timelines within the exchange and really kind of maximize them as much as possible. So that really is kind of where APX built from, and we built it around a very client focused and customer service forward model. And so that's our we strive to really provide a 5-star experience with every exchange and every client that we handle on the 1031 exchange side of things.
That is fantastic to hear, and I can't wait to kind of jump and dive into questions. So what I wanted to kick this off with first and foremost, I tend to be a really visual person, and it's kind of like the why this matters, because I always hear when I'm speaking to our clients, a lot of times things are thrown around. They talk to another agent, they talk to somebody, friend, family, and they say, if I cash out, it's only going to be like 15%. I'll say, you only got a small piece of the puzzle there. So what I really want to do is kind of walk through, just an example of kind of situations that we hear in today's market. But let's say that I bought a rental or investment property back in, say, 2017. So I've owned it for about 8 years. My original cost basis is 500,000. That's what I bought it for, plus, any type of capital improvements. So there's my cost basis. And I'm thinking about selling this property, this year, either the end of this year or the beginning of next year. And when I sell this property, I'm going to have net proceeds. So after all the selling costs of about $1 million. So my long-term capital gain is going to be right around 500,000. This is pretty common what I've been, in talking with a lot of our single-family home investors within our network. So what that's going to look like is, first and foremost, you're also going to have depreciation. So what I always tell people is there's these 3 buckets that you want to concentrate on. There's your federal taxes, your California state taxes, and then you have depreciation recapture. Pretty much those 3 buckets that you want to be at least cognizant of when you are trying to come out and decide, what's this going to look like? And again, I just want to point out to you, I'm not a CPA, neither is Jake. Definitely sit down with your CPA and go over your individual numbers. This right here is just for example purposes, just to get you guys thinking about what this might look like in terms of potential capital gains taxes that you might have to pay if you were to cash out. So looking at depreciation, so how you calculate depreciation, you take your cost basis, you can only take depreciation on the actual building or structure. So you've got to back out that land value. A lot of times you can look at your property tax records. They usually break those out as well. So if your cost basis, original cost basis was 500, you remove your land value. I'm just going to say for all practical purposes, that's 100,000. So you have a depreciable basis of $400,000. Now for residential property, on a straight line method for simplicity, it's 27 and a half years you can depreciate that. So you just divide it by 27 and a half years. If this were commercial, it's 39 years. So on an annual basis, you can actually deduct from your taxable income $14,545. Over 8 years, that's a total of $116,360. So to calculate your depreciation, when you sell this property, for the federal tax rate, it's 25%. So you're going to get taxed nearly $30,000 for federal. You can also depreciate against California as well. And California is going to be based upon what your tax income bracket is. So again, with federal taxes, you do have a 0% tax bracket. And I've heard people say, oh, I'm in the 0%. Be careful about that because they stack that on top. So first, if you have any other taxable income, if you're making money through a job or other investments, etc., that's going to go in first. So a good majority of the time, you're not going to qualify for much, if any, of that 0% tax bracket. Most people are going to live in this 15% tax bracket, and high income earners are going to live in this 20%. With California, same thing. It's all tiered. It's dollar for dollar. Not many people are going to live in this 1% tax bracket. You're likely going to spread yourself and it'll be marginalized over these 10 different tax brackets you have here. So for this particular example, again, California, you're likely going to be paying recapture tax around 9%. If you're kind of in the middle there in terms of income. So you'll be paying California depreciation back as well, about 10 grand. In total, depreciation recapture, almost $40,000. Then you look at your long-term capital gain, that 500,000. The federal tax bracket you're likely going to be falling in is most likely that 15% tax bracket. That's $75,000. California, this blended out of all the different tax brackets, probably somewhere in the 9% range. But if you're, again, a higher earner, it could be more. That's an additional 45,000. These three taxes add up to almost $160,000 that you will be writing a check for if you cash out of this property to your silent partners, right? That have not helped you gain that. So again, your total effective tax rate is going to be closer to that 32%. And again, this is a pretty mild example. Could be more, could be less. Definitely talk with your tax advisor and make sure that you understand what that looks like. Because again, this all comes back to understanding that before you make that decision to either cash out or potentially defer those gains into a new property utilizing a 1031. So, Jake, I wanted to jump in to some questions here that commonly come up. So, really, what exactly is a 1031 exchange, and how can it help me defer these capital gains into potentially a new investment?
Sure. So that number 1031 is actually in reference to the section of the Internal Revenue Code where this appears. And what it does, simply put, it allows you to defer paying capital gains taxes on the sale of an investment property by reinvesting into another investment property. So there are some strict regulations. The IRS has very strict timelines and some regulations for you to get that full tax deferral, which that's what we're going to be discussing today, and how to maximize that benefit that is there for you. But by selling an investment property and using the money to buy another investment property, you can defer those capital gains taxes indefinitely.
That's fantastic. And I mean, is this like a one-time thing? Can I do it multiple times, as many times as I want? How does that work?
Right. So there's no limit on the number of 1031 exchanges you can do. You can do it on any investment properties you have. So we have, some clients where they have multiple properties all over the place, and they'll have multiple exchanges going on at one time. You can even actually, in situations, you can combine multiple sales and use that to exchange into maybe one larger property. We've had clients that have done that where they've taken a portfolio of single family rentals, and in order to help with their operation and just making it a little bit more, get the scales of economy there, with those properties, they've exchanged multiples into one single asset and maybe a large apartment building. So there's a lot of ways to be strategic there with the 1031 exchange as well.
That's fantastic. And are there any type of properties that are excluded, or what types of properties qualify? Can I go from single family to single family, both investment? Can I go from a single family to a farm or a business property, a commercial property? Are there any types of restrictions there?
So that's a great question. So there's a lot of confusion around that as well. There's a phrase called like kind in 1031 exchange, and when you hear that phrase like kind, it does not mean that you need to buy the same type of property, right? So you don't have to go from a single family to another single family. The qualifier when it's saying like kind is in reference to how the property is used. So the property that you're selling, there has to be like a holding period. So it was a property that was either held for use in a business or trade or for investment. So on the sales side, the qualifier is that it was an investment property that you'd be selling. And then on the purchase, it's the same thing. The like kind means you're selling an investment and then also going into another investment. As far as the type of real estate, it's pretty much anything that would be an investment property. So you can sell land and go into commercial. It's very, very open ended. There are even certain types of assets that you can exchange into that may not be as commonly known, some like fractional investment type options, as well as even oil, gas, and mineral rights. So it is very, very flexible with what you can do, and it does afford a lot of flexibility with your exchange. But the limiting, think of it in terms of if it's going to qualify, think of it as what the use of the property is. And if it's primarily personal use, so if it's your primary residence, wouldn't work for a 1031 exchange. If you have a second home that doesn't really have an investment component at all, that wouldn't qualify typically either. Now, both can be transitioned into an investment and eventually exchanged as well. But if the immediate use of it is primarily a personal use, that's not something that typically would qualify.
Great. So as an example, I mean, if I were considering selling my single family investment rental property, could I exchange that for, say, like a vacation rental? Would that potentially qualify?
Potentially, it's going to depend on how much it's going to be rented out, right? So like it would need to be primarily for rental use, and you would want to rent it out. But you can buy a vacation rental, but if you're going to be using it primarily personally, then you wouldn't want to go that route. It would not be something that's where they would get you. If you're going to be using it more for personal than for investment, that would not work.
Are there any guidelines for a situation like that in terms of, how long I need to be renting it out and how long I could potentially use it for vacation purpose?
Yeah, so it does afford a little bit of personal use, but it is capped. There's very specific rules with that, and you want to always consult with your CPA or your tax advisor when doing it. But generally speaking, the way it works is you can use it personally for 10% of the days it's rented. So you need to have it rented for every 10 days you rent it. You can have 1 day of personal use, but that is capped at 14 days. So your maximum amount of personal use is 2 weeks, but it also has a qualifier of how much it's used for investment.
A minimum. Perfect. And then, what are everyone talks about the timelines of what those timelines look like, because they are, very clear and there are deadlines. What do those look like, and what do our owners need to look out for and keep in mind?
Yeah, the timelines are very strict, and they're set in stone. They don't change unless there is like a federally declared disaster or something like that. That's the only time there might be a change in those. But otherwise, if there's nothing in that situation, you're looking at 180 days total time to complete the 1031 exchange. But within the first 45 days of that exchange period timeline, you have to identify in writing your potential replacement properties for your 1031 exchange. So the exchange, like the identification period and the exchange period, run concurrently. So the first 45 is the identification period. The remaining 135 days is the exchange period, for a total of 180 days to complete a 1031 exchange.
Perfect. What triggers that first day of that 45 days? Is that the actual close of escrow when you close on that property?
Exactly. Yes. So it is the date of closing that you would use as that calculator. And so when we have a sale that closes as a 1031 exchange, we will send out a confirmation of closing, and we'll outline those timelines. And those timelines are the most critical piece for the next 6 months. That is the most critical thing on your timeline. You want to make sure to get it done, and you don't want to go past them, right?
If I identify a property in the first 45 days, and then let's say on day 60, I found a different property that I fell in love with, can I switch to that? Is that okay? Is that something you can do?
Unfortunately, it is not. We get that question quite often, but that's why it's really, really critical to make the most of that first 45, because once that 45th day comes and goes and that identification form is signed off on, that is set in stone. And you can't change it anytime after that 45th day.
Gotcha, gotcha. So what are, in your opinion, and doing this time and time again with your clients, what are the risks or the most common mistakes that can cause a 1031 exchange to fail?
So not following the timelines is a big one, right? You have to get that done within the 45 days. You have to close within the 180 days. One that even, but that one that predates that even would be not getting it set up in time. We get a lot of calls where people are like, I'm ready to set up my exchange. I closed last week. That doesn't work. We need to have that exchange set up prior to the close of the sale.
So when should an owner that is selling, when should they actually reach out to you and your team? Should they do this before they even think of putting it on the market? Should they reach out to you when they have a buyer and it's in escrow? What does that look like?
It depends on each person, like if they know pretty well what they're going to be doing, like they have a team in place and they're pretty set on the transactional side and don't need to talk strategy. We can get involved once they're in contract on that sale. We just get everything set up prior to the close. But if it's someone that's completely green, never had done an exchange, or just intimidated by the whole process, they can get us involved before listing, so we can talk through the whole process, talk strategy, and then also if they need any referrals or anything for any different parts of that transaction, we can talk through that as well, and get them set up with the right people to make it a nice, smooth, seamless 1031 transaction, start to finish.
Perfect. So how does it work with escrow in your services? So what actually happens in that interaction? Can they use any escrow company and then your company kind of sits on the outlier waiting for the funds to come directly from escrow?
Yes, exactly. So you can work with anyone that you want. We just facilitate the 1031 transaction. We work with all different escrows all the time. So you can work with your agent that's listing it, the escrow that they prefer, that you prefer, and we just kind of get involved and coordinate directly with that escrow, to have our documents prepared, signed off on, and then we review everything prior to closing, make sure everything's buttoned up from the 1031 exchange side. And then once that closing happens, they send us the money, and we will hold on to it between those two transactions. That's part of the other piece, that chain of the money being held by the third party intermediary is what also allows that tax deferral treatment. So that is a necessary step within the 1031 exchange.
Perfect. And in terms of looking at the exchange of properties, I mean, if you're selling a property here in Southern California, you can replace that with a property pretty much anywhere within the United States, or could it also be
Correct.
globally?
It can't be globally. So the 1031 is a federal tax code, so it is good to go anywhere within the United States. But because of that, it is here. It has to be domestic property. It cannot be international property. So you'd have to do an exchange, but you can go, all around the country as far as locally here in America.
Fantastic. If I'm trying to maximize my 1031 exchange so I have no tax liability, do I have to buy a property that is, that at least meets that capital gains requirement, or can I buy something, twice as expensive if I want to upgrade? How do I maximize it in its entirety?
Sure. That's a great question. And we do get a question about a lot where people think they just have to do the exchange with just their gain or just their equity piece, which is not accurate. That will set you up to be paying taxes. The way to get to maximize the tax benefit, you need to buy equal or greater to what you sell for, as well as use all of the proceeds from the sale on your purchase or purchases. So you can buy multiple properties through a 1031 exchange. You can sell one and buy multiple, but aggregately, you want to make sure that those purchases are equal or greater to what your sale price was. And again, use all of the money in that from that sale on the purchases. As far as values, equal or greater is pretty much that's the baseline of the minimum reinvestment you need in order to get the tax benefit. But you're not capped on how much you go on or how much you buy. So you can take it. People will leverage debt in order to scale up and buy more. So like if they have 500,000 coming out of it in terms of proceeds and they use that as a down payment and say they maximize their leverage at 75% loan to value, you can buy up to $2 million in that
Oh, wow.
situation. So a lot of people use it to grow their portfolio, go up in units, whatever that may be, but you're not capped on how much. But from on the minimum side, equal or greater to what you sell for is what you're looking at on the reinvestment.
Gotcha. And then kind of going to the opposite spectrum, if I am actually looking to cash out a little bit, but want a 1031 exchange, maybe downgrade into something else, a smaller investment, can I do that? I've heard of a term, I think it's called boot. Is that something that I can do?
Exactly. Yeah. So boot is what that's in reference to any money that's left over in the exchange. So there's a couple ways boot comes up, but you can do that. You don't necessarily need to buy equal or greater. That's just how to maximize and get the full tax deferral. Any amount of money that you take out of the exchange, so you can pull out, say at closing, you're like, I need $100,000 that for whatever it may be. It doesn't matter why, but you pull $100,000 out of that sale, that $100,000 would be subject to capital gains. So you would need to pay a little bit of tax, but you get a tax deferral treatment on the remaining amount that was rolled into the 1031 exchange.
That's perfect. That gives you a lot of flexibility in terms of what you're looking to accomplish. So let's say that I'm thinking about doing a 1031 exchange and I find the perfect replacement property. Can I potentially buy that property first and still do a 1031 exchange on it?
Yes, you can. It's called a reverse exchange. There is a structure that would allow you to do that. So that does happen frequently, but the one thing with the reverse exchange, there is very, very specific requirements with how that transaction is structured. So again, we need to get that set up prior to closing on the property because we need to have a special structure in place on that acquisition in order to be able to roll the exchange into it. So it's very critical, regardless of what order you're going in on the exchange, to get in touch with the qualified intermediary in advance of closing so that it can be structured properly, whichever kind of exchange it's going to be.
Fantastic. In terms of ownership structure, because I get this as well, is there any type of beneficial or preferred ownership structure? Like if I own my investment property as, Ryan Prazen, sole proprietor, or if I own it as a LLC or a corporation, does it matter, or is there any benefit to those just in terms of the 1031?
So in terms of the 1031, it absolutely matters how it's held because from the one of the biggest things in the 1031 exchange is maintaining the same taxpayer. Since it is a tax deferral strategy, what we're deferring is the taxes. So we need to keep that taxpayer consistent from both transactions, right? So if you're selling in an LLC, you're going to want to acquire the new replacement in LLC, or, as Ryan Prazen as an individual, you'd want to buy it as an individual on the other side. There are some like single member LLCs or disregarded entities for tax purposes. There is some flexibility, but it still needs to follow that same taxpayer ultimately. So you want to consult with your tax person when doing that. So before doing the exchange, if you want to make any adjustments or anything like that, just make sure you're talking with your tax person and that they're aware, and talking strategy with them as far as, will this have an impact to my 1031 or effectively change the taxpayer? Because if you do change the taxpayer from sale to purchase, it could get you into trouble and be in a situation where you do end up paying tax on it.
Perfect. So just like you said before, get in contact early and make sure that you understand everything before you get into it. That's perfect. So we have a lot of owners that have lived in their property as their primary residence and maybe for job relocation, have moved. They've converted that property into a rental, into an investment property. Are there any type of timelines or holding periods that would need to hold that as an investment before they can 1031 exchange?
Yeah, so with the 1031 exchange, the one of the requirements is there is a holding period on how long you've held it as an investment, right? So like flips typically won't work, or there's other different types of properties where it wouldn't work from just a holding period standpoint. But on the side of the converting it to an investment, the 1031 is for long-term capital gains. So those kick in after at least a year or more of whether it be ownership or use as an investment. Anything with a primary residence component, it's recommended probably 2 years at least prior to doing that. So if they lived in it and then they rented it out for 2 years, that would generally be a safe timeline in order to do the 1031 exchange. And in that particular situation, there is also a primary residence tax credit that can apply. If they lived in it for 2 of the last 5 years and then now it's an investment, you have, as a primary residence, you have the benefit of being able to basically be forgiven up to $250,000 in gain as an individual, or up to $500,000 as a married couple. So if they're then it's now held as an investment. They've had it as an investment for 2 years, but also have that applicable. They can take advantage of the primary residence tax credit. And then if there is gains that exceed that amount and go above and beyond, they can also combine it with the 1031 exchange for a full tax deferral, where they're able to actually put some cash back in their pocket as well.
That's amazing. So essentially, if they lived in it for at least 2 out of the past 5 years, so they can rent it for up to 3 years, they just have to close before that 3 year to get that capital gains exclusion. Is that correct?
Right. Yeah. You want that fifth year is where you really want to start maybe exploring options as far as what to do on that sale, and to maximize both of those benefits at the same time. Yes.
Perfect. I know we only have a few minutes left. The last question I have. So we tend to also have a certain amount of owners that just don't want to be property managers anymore. Even if they've got a third party company, they're done making those decisions. Do they have options? Because I've heard of things, and you've mentioned it to me a few times, DSTs or fractional ownership. Can you tell us a little bit more about those and what type of benefits that those can bring our owners?
Yeah, absolutely. That's something that we've seen a huge uptake the last few years, of a lot of investment owners going into these DSTs, or what they're called Delaware statutory trusts. And effectively, it's fractional ownership in a much larger, usually like an institutional type property. You know, think of a Class A type property. Think of like a large multifamily, maybe like a 500 unit multifamily with all the amenities, all of that, brand new property. And what happens is they can buy a fractional interest into that property, and it's fully passive because it's owned and operated by a sponsor, and they sell back equity to the client. So they're able to invest in this in a smaller amount as well. So typically it's like 100,000 minimum buy in each of these DSTs. But what it does is it opens it up to owning real estate on a like a higher level, right? So you're able to be invested in a much larger property. It's very similar to how like a REIT. Think of like a REIT where it's a real estate investment trust. It's just you're invested in this. You get your payouts paid on a monthly basis, typically with DSTs. But it allows investors to invest in just higher quality real estate and not have any management headaches at all.
Seems like the mutual fund of real estate then.
Exactly. But the difference is it's structured in a way that qualifies for 1031 exchange. So
And you
we've
still
seen
get all
a
those same benefits like depreciation and whatnot? Very
yes,
cool.
all of that.
That's
Yep.
amazing.
Yes.
Is,
And
is
oh, go ahead. Sorry.
yeah, I was going to see, is there any type of y- you know, being liquid and able to get your money back? Because from what I've heard, those are usually structured. When you get into them, you're definitely parked there for maybe 5 to 7 years.
Yeah, that is the one downside. So with when you buy into a DST, you really don't have much control at all, right? So you buy into it, the sponsor that is managing and operating the property, they determine when that property sells. So it is pretty illiquid in that sense. You are stuck in that investment until it goes full cycle and then they do the disposition of that asset. One nice thing at that point, you have the ability, they'll send out a disposition form and they'll say, are you going to, you can exchange, you can cash out, you can do a combination of both. You have the option at that point with what you want to do moving forward. And you can always go back into more traditional real estate. Maybe you're in it, you're like, I don't like having no control. I'd like to have an investment here locally. You have the option, you can exchange back into local real estate and get back out of that DST at that time. So it does give you some. It's not flexible on the timing as far as access to the cash, but it is a good way to defer the gains and be fully passive on that investment.
That's fantastic. All great information, and I'm sure it's going to be helpful for our audience today. I did put up on the screen all of our contact information, both myself and Jake and his team. So feel free to reach out to either of us if you've got additional questions or more specifics on your scenario. We would be more than happy to talk with you about that. So again, thank you so much, Jake, for spending the last half an hour with us. All great information. And we look forward to talking with you more with our clients and facilitating some 1031 exchanges in the future.
Absolutely. Thank you so much for having me. This was great. I really appreciate you having me on, and great chatting with you on the 1031.
Awesome. Well, thank you, everyone. This concludes the webinar. Have a great day, and we'll be in touch.